And one of the biggest business stories of the last week centers on the state's unemployment trust fund. This is a state fund that pays unemployment benefits to laid-off workers. It's been about $360 million in debt to the federal government, having borrowed a lot of money during the past 2 years due to the spike in unemployed workers. In the last legislative session, state lawmakers passed 2 bills to help shore up the fund. One made changes to the benefits allowed. The other gave the governor authority to call an election for a bond issue to float bonds to pay off the debt to the feds. The theory being that the state could pay off the debt for a lower interest rate on the bonds than the interest owed to the federal government. Now, new data released by the Arkansas Department of Workforce Services this week shows that a bond issue might not resolve the problem any less expensively than letting the new changes take effect. In short, without bonds, the trust fund balance could be debt-free by 2015 and have a balance of about $233 million by 2017. With bonds, the debt would be erased more quickly, but by 2017, the trust fund balance would be about $233 million, just the same. Well, I caught up with Randy Zook, president of the State Chamber of Commerce, to discuss this issue earlier. His organization has been actively working the issue on behalf of the state's employers. All right, let's talk about the changes that came out this week from the Department of Workforce Services, Randy. Basically, very positive news about the unemployment trust fund situation. Talk to me about the changes that were made in this session, and what do you think had the most impact?
Roby, that's you're referring to Arkansas Act 861, and this was an effort to moderate the benefits under our unemployment insurance program. I guess the highest impact item is probably the one regarding the treatment of quits and discharges. This equalized the treatment under that program. You know, there's been some comment in the press that this was like a frontal assault on unemployment insurance. It's far from that. It's a very modest trimming of benefits. We removed 1 week of coverage for the Arkansas program, which reduced unemployment benefits from 26 to 25 weeks. That has only about a $5 million a year impact on the program, and it does not affect anybody's ability to collect under extended benefits. So it's a very modest trimming of benefits, but one that I think is very important. And the other one that's probably getting the most attention is the fact that we eliminated indexing of the benefits, where the minimum and maximum benefits automatically move with average wages. We make that a statutory limit, and we'll have to go back in the legislature and vote on any changes in that in the future. And I think that's an important change, because that makes us much more competitive with surrounding states. We have a very generous benefit compared to all the surrounding states. In fact, we pay either the highest or second highest level of unemployment insurance of all the surrounding states. So it's a very positive move, a very modest move. That, coupled with the increase in taxes that employers pay from the 09 session, where we raised the wage base from $10,000 to $12,000, those two put together have made a very significant change in the outlook for the Unemployment Insurance Trust Fund for the better.
And now, all told, we're talking about $60, maybe $75 million in annual savings, somewhere in that range, from those changes to that legislation. Did it surprise you when you saw those first numbers from Workforce Services this week that it had changed that much?
Well, it didn't shock me, but it was a very pleasant surprise to learn that the impact is that significant. And the other thing that is factoring into this calculation, Roby, is the fact that more and more people are going back to work, and in turn paying into their employers are paying into the system. So that there's added revenue from both the tax increase as well as the fact that more people are back at work. And that's the best news in this whole report, is the fact that people are getting back to work slowly but steadily as the economy improves, and that's the best possible outcome.
And hopefully that's a sign of things to continue to come. To bond or not to bond? That is the Shakespearean question that you've been asking your members. The new numbers from the Department of Workforce Services suggest that it might not be that practical to bond. What's your takeaway?
Well, we're trying to assess the view of Arkansas employers, because the contributions to this fund are the sole responsibility of Arkansas employers, basically the businesses across the state. So we're trying to make sure we have a good understanding of how they view the current situation. It appears that there's almost total agreement that it's not necessary to bond, that if current conditions play out over about the next 4 years, the system will be back to a positive balance from its current deficit of about $360 million. And then, assuming we don't have another drastic recession, the trust fund should be back to an adequate level of positive balance within about 3 or 4 years beyond that. So it's about the best possible news we could have gotten in regard to this situation.